It is Monday, and that means it's time for the real estate show. And we have the most exciting topic for today, and that's numbers and taxes. But it actually will be exciting because real estate is one of the best, if not the best vehicle that you can use to limit your tax liability and really use the tax code the way it was designed. Because let's face it, the government actually wants to incentivize you to invest in real estate. And that's why the tax code is written to be so advantageous for real estate investors. So today we're going to be talking about double D's. Now, get your mind out of the gutters, not those types of double D's. We're talking about two D's as it relates to taxes. You like that one? All right, here we go. So the first D we're going to be talking about here, let me just put double D's. The first D we're talking about is going to be called deductions. Okay. So if you own the real estate, because there's different ways to invest in real estate. And if you watch these live streams, you'll know that you can invest in single family homes and own everything on your own. You can invest in syndications like we do with apartment buildings. You can invest through real estate funds. You can invest not only in multifamily, but office space, commercial retail, you name it. There's so many different ways you can invest in real estate. Some I feel are better than others, but there's so many different ways you can slice the cake. But the main overarching theme between all of them are the tax benefits that come along with investing in real estate. So with deductions, what I'm going to do first, before we get to the more exciting D, the second D, is I'm going to walk you through exactly how deductions work and what types of things you can deduct just because you happen to own real estate. So this is going to be for you if you own the rental property, the investment property. So maybe you own a duplex, triplex, maybe you own an apartment building and it's yourself or your company. This applies directly to you. So what happens is when we own real estate, it's going to generate revenue, right? So you have revenue, and so that's money coming into the property, right? So you have rents, laundry, parking, any type of income that's generated by the property is going to be classified as revenue. It's money coming in. But then we have expenses that go out, right? So we have operating expenses. It's called OPEX. And this is the cost of doing business, the expenses that the property incurs to operate. And these are the things that you can now deduct from that revenue and save you taxes while that property appreciates. And even better, as you implement your business plan, your value add business plan, and you're forcing the value of that property to go up, not through just waiting for the market to appreciate, but because you found a gap in the marketplace where you can move that property. And now you can move the rents from maybe $1,500 a month to $1,750 or $1,700 and improve the value of the asset. Okay. That's a whole different topic for another day. So what's going to happen is the revenue comes in. Now, OPEX is going to go out. So these are your expenses. So you're going to have a number of different things. So first of all is you can deduct your taxes. So the property taxes that you pay, some states you're going to pay a lot and some municipalities are going to pay a lot, others not so much. It really depends on how broke they are. But you've got taxes that you can that you're paying, and you can write those off. Now you have interest payments. Maybe there's on your financing with your mortgage, right? Your first mortgage, you can write off all of the interest for that property. A second mortgage, all of that interest. A line of credit, maybe the property has a line of credit. You can write all of that off. So you're basically using the bank's money to acquire a piece of real estate. You're going to earn revenue, and now you can actually deduct from that revenue the interest you pay in the first place that you use to get the property. This is why real estate works so well and is so advantageous. You're literally able to borrow money from the bank, buy an asset that's going to increase in value, and write off and deduct from that revenue and the tax you're going to pay all of the interest for that loan. That's the most beautiful thing about investing in real estate. So the interest payments that you're going to make, the interest you're paying, the insurance or the insurance if you're in the States, depending on how you want to say it. The insurance or the insurance. So you have to insure the property. Maybe you have flood insurance. Maybe you have general liability insurance, slips and falls, like that type of thing. Fire, all of the things that may happen with the property, you want to make sure that you're covered. Now, you can write this stuff off too. So you can deduct the cost of the insurance that's going to make sure that you can go to bed at night and sleep soundly and not worry about all these things happening. You can go to bed at night knowing that everything's covered, but now the cost of that insurance is deducted from the revenue as well. And then any repairs you're making to the property. Maybe you have a gust of wind and some roof shingles fall off. Perfect. You can deduct all of those expenses as well. Maybe you have to repair the driveway or the parking lot or the sidewalk, or you have to repair an appliance like the dishwasher. Maybe you have to repair some plumbing, the eaves troughs, whatever it is. You can deduct all of those costs from the revenue that your property generates. So this is the thing. We know that over time, the value of real estate goes up. Beautiful. This is why a lot of people invest in real estate. And we know that the more work we do, as long as it's designed in our business plan to increase the value of the asset, we know that's further going to force the appreciation of the asset. We know that to be true. We can do work to improve the value of the asset. We can take loans and use other people's money, the bank's money, to acquire the asset. We can do all this work. We can insure it. We can do all of this stuff. And the government allows you to deduct all of those costs that actually work in your favor because you've now bought an appreciating asset. The government allows you to deduct all of those expenses and you're going to make money. Not immediately. Real estate does not get rich quick, but over the long term, you will make money. You will be wealthier and you are going to pay less tax because of the way the tax code is written. This is why so many people, you look at the wealthiest families in the world, a large part of most of their portfolios are in real estate. Why? Appreciation, stability, cash flow, all of those things, but also tax benefits. So deductions, being able to deduct all of the expenses that you're putting in and you're incurring as you're owning this appreciating asset that's going to go up in value, all of the things that you have to do, you can deduct those from your revenue. Perfect. So what does that mean? It means if you own real estate, you're able to be very efficient in your tax liability and your tax obligations, because you're basically you can write off everything that goes into running this rental property. It is a beautiful system because you're owning in this asset that's going to go up and you're able to write all these things off. Additionally, we have something called capital gains. So you're going to pay less tax on the profit you make when you sell the property or when you go to sell it, because it's special. It's an investment. It's capital gains. So that's a further way you're going to limit your tax obligation just by owning real estate. That's another topic for another video with the capital events and capital gains. All right. So the first D with our double Ds of tax savings are deductions. You generate revenue with your property. Money comes in. You have to put money out in order to fuel that property, look after it, everything. You are able to write that off and save money and use that against your taxes that you have to pay just because you own real estate. All right, beautiful. The second D in our double D of tax savings is depreciation. Now, this is an exciting word. Any real estate investor that I know gets excited when we talk about depreciation. Why? Actually, I should tell you this. So there's this one guy I know, and the biggest joke he has going around is it's like talking about income tax. He's like, "Oh, what's income tax?" And the joke is, well, because he doesn't pay income tax because he owns real estate. So you look at some of the wealthiest things, and now we're in the election cycle right now in the U.S., and so a lot of Trump stuff is going around, and it's like, oh, Donald Trump didn't pay taxes. He's like, well, because I know how to use the tax code, and I know how to use depreciation to my advantage. Those clips are on fire right now, just going around, just because of the time of year. But it's true. The large real estate owners love depreciation. Why? Because you can actually use the tax code to save money. Let me explain how this works. So with commercial property, okay, so let me erase this here so I have more room to draw. Let me draw the chart for you. So here's the chart. Over time, that we know the value of the asset goes up, right? The value of real estate goes up over time. This is the value. Now, what happens when you own real estate for a long time? Well, you need to do repairs. The building gets older, things break, right? So the government allows us, through depreciation, the government allows us to bring the value of the asset down to zero over time. So on one side, we know the value is going up. We're owning this asset that's appreciating, but then because of the tax code and the government wants to incentivize us to put money back into real estate and keep it up, they're allowing us to take the value of the asset on paper down to zero. This is beautiful because on one side you have an asset that keeps going up. On the other side, the value on paper keeps going down as it relates to taxes. And in the United States, with commercial property, we can depreciate over 39 years. Now it's 27 and a half for residential property, but we do a lot of commercial stuff, so I'm going to focus on commercial. Now, why is this important? It's important because of the time value of money. So let's say this is time right here. $1 today is worth far more than $1 in 1 year's time, right? Because of inflation, right? The more we print money, the less valuable our dollar is. That's why people were able to buy houses for $2,000 back in the day. That's why people got paid a shilling a day to do some work way back in the day, right? And prices have gone up because of inflation. Our economy is built on inflation. If inflation stops, the economy dies. So we know over time, the value of our money is going to decrease. So that means $1 in my pocket today is worth far more than $1 a year from now, 5 years from now, 10 years from now, or even 39 years from now. How does this relate to depreciation? Well, because the government allows us to take tax credits and depreciate the value of the asset over 39 years. Which sounds pretty good, right? I can wait 39 years. I have all my tax credits. I can use those to offset the taxes that I'm going to pay. But this is where something called cost segregation comes into play. Now, cost segregation is a really, really special thing that we can use in the United States, and it's very, very advantageous. Let me explain what happens. So let me draw my chart. So we got 4 boxes. We already know that we can depreciate an asset over 39 years. So we can bring that value down to zero, and we're getting those tax credits from the government because of the way the tax code is written to favor real estate investors. Now, we know that real estate can be broken up into different parts, right? So maybe you've got some plumbing over here. Maybe you have some electrical, like the wires in the property, right? Maybe you have, landscaping. Maybe you have a pool. Maybe you have signage, trees, that sort of thing. Basketball courts, that type of thing. And then you've got the building. So maybe it's an apartment building. So you've got the shell of the building, and then you've got the land that property sits on. The government allows us to front load the depreciation. What does this mean? It means that instead of waiting 39 years for all of those tax credits, I can front load and accelerate the depreciation. So now I can depreciate over a more condensed period of time. Why does this matter? Time value of money. If I can get my depreciation front loaded to the first 5 years, Now that's far more valuable dollars in my pocket than having to wait 39 years for the depreciation. You follow what I'm saying? So because of cost segregation, I'm now able to front load that depreciation and put more valuable dollars in my pocket because I'm not paying that tax up front. I would much rather pay tax later on because it's less valuable dollars. I want dollars in my pocket today. So how does this work? So on plumbing, electrical, like that type of stuff in the property, we can now depreciate that. Instead of 39 years, we can front load it to 5 to 7 years. With landscaping, poolside, like the actual physical, oh, there's my son right there looking sharp, catching a fish. I gotta bring it back. There we go. We can depreciate things like this tennis courts over 15 years. 15 years instead of 39 years, right? Less than half the time, more valuable dollars in your pocket today. The actual building itself, right? We will depreciate that over the 39 years. And the land, well, land doesn't depreciate. So instead of just keeping the whole asset together as one and waiting for 39 years, right, to depreciate, which is still just fine, right? The government's worked this out to work in your favor, right? You can depreciate and get tax credits for 39 years. But because we're able to do what's called a cost segregation study, we're able to separate all the different parts out of the real asset and break it up to, the electrical, the plumbing, that type of stuff. Then we have the landscaping, the physical things in the on the asset, so sidewalks, driveways. Then we have the building, the shell, the actual construction. So that's 39 years. Then the land's not going to depreciate. So instead of just bundling everything into one and waiting 39 years, we're able to separate it through the cost segregation study and now use the tax code in a more advantageous and efficient way to front load that depreciation and put more valuable dollars in your pocket sooner. So now you can actually take those and go out and acquire another asset and do the exact same thing. Right? Because the whole purpose of this is to keep more dollars in your pocket today. So that way you can set yourself up with cash flow producing, appreciating assets that you can leverage and take advantage of tomorrow and in the future. This is how the smartest people in the game make their money work. It's not how much you make, it's how much you keep. That's a Robert Kiyosaki quote, and it's so true. And because you own real estate and you invest in real estate, you can make the tax code work to your advantage. So we got deductions on one side. We are able to use the bank's money, acquire a piece of real estate, improve it, repair it, keep it up, and deduct all of those things from the revenue we're going to generate and pay less tax. Then we're able to use depreciation and get tax credits and bring the value of an asset down to zero, even though we know over time appreciation will move the value of the asset up. So we own an appreciating asset, but the government allows us to bring it and depreciate it down to zero on paper. And then we can put that on steroids using cost segregation studies and really front load that depreciation to make sure we're putting the most valuable dollars in our pocket today instead of having to wait for, let's say, 39 years. This is how you make real estate work in your favor. Okay. So if you are thinking about getting into real estate, if you want to learn how to invest in your first apartment building, maybe you're investing in single family homes and you want to get into your first apartment building. If you want to really accelerate the growth of your portfolio, just go to theapartmentaccelerator.com. And this is where we help people. We teach them how to get into apartment building investing. This is the best program out there for getting people from, hey, I'm in square one, I'm doing single family home investing, and getting them into their first apartment building deal. So go to theapartmentaccelerator.com. So this is how you save money using real estate. It's the best thing ever, the best thing since sliced bread. So put this into action, go buy a piece of real estate, leverage the double Ds. It's more fun for everybody.